And welcome back to the MedTech Wealth Advisor Show, the show dedicated to helping the MedTech community make smarter decisions with their money. We're here to help you look at your personal finances from every angle and align your money with your values. Today, I'm joined with my partner, Matt Finley again. We're going to go through a grab bag of questions we get from clients. We'll just call it our mailbag Q&A episode. It was pretty popular last time we did this a few shows back, and so we pulled together some questions from clients and in kind of a couple that we're getting from so many clients, we just made it into a question that we're pretty sure everybody's wondering about. So with that, Matt, welcome back to the show. This is going to be a good one. I think we had really good feedback from the last one, and I think people like to hear about, the things that matter to them. So let's just get into it.
Sounds good.
All right. So going to the mailbag, the first one we got was a question about a 401k plan. So this one, and I'll just read it. So Dale from Minneapolis says, my 401k has done fantastic over the last 5 to 6 months. Somebody at work told me that I should make it more conservative, but that doesn't make sense to me when I'm making so much money. By the way, I'm 55 years old. What do you think? Well, this is a good question. I'm glad this came in. There's a lot to this, and we kind of have to back up a second. You and I were talking about this before the show, Matt. We need to start with the planning angle, and it's kind of hard to give advice about the 401k plan until we know, what have you done with your planning? How much have you saved up? When will you be, hoping to hang it up and retire? So that'd be the first question back to Dale. I would say, do we have a financial plan in place? We would look at, how much do you need? So what's your number? Fidelity used to have that phrase, what's your number? And although that's not exactly the perfect question, it gets directionally what we need to look at. And what else you have going on? Matt, jump in with anything that you have on your mind here. But
yeah, I think the psychology of that comes into play quite a bit too, right? Like a little bit of the opposite of FOMO, right? It's okay, right. Now I've accumulated some. When is that shoe gonna drop? Type of fear. It's very common. Stock runs up a ton. When do I sell? Type of mentality. Bitcoin goes to 100,000. When do I sell? Right?
Exactly.
Definitely very common. But I think it does come back to what you just mentioned: is what's your situation? What's your time frame? What do you need in retirement? Like that, for us, that drives a significant part of our risk profile for a client, is what do we need to try to achieve for you? But I would just, maybe we'll talk about this a little bit later in some of the other questions, but
absolutely, just
because something's up doesn't mean it has to come down.
Well, yeah, absolutely. And, the fact that it's key that this questioner is age 55. So, I already mentioned, we don't know when Dale plans to retire. It'd be one thing if it's 5 years from now. If it's 10 years from now, I'm not so sure we need to be too concerned about the market. I mean, yes, it's just like you said, just because it's gone up doesn't mean that it has to come down. Even if it does, we've talked about this on past episodes, that even if you happen to have the misfortune of investing at the peaks of all of the last stock markets, as long as you had enough time to recover and continue to invest in your 401k and just, not panic, you actually come out with a very solid rate of return anyway. It's no one's going to ever time the tops and the bottoms. So just kind of put that out of your mind. So, I would tell Dale, if he was in front of us, say, look, if you've got 10 years left, maybe we just go back and do some simple rebalancing your portfolio, get it on track to what makes sense for your situation, and then just don't worry about it.
Reality is stocks are probably going to outperform bonds over a 10-year period, right?
They are.
So that's, again, knowing the time frame and what the client needs to achieve. New highs beget new highs. Otherwise, we'd never have new highs, type of thing. So I think the psychology plays out more than anything. But it is a valid question. We do get it all the time.
Absolutely. And it makes sense. And I think we've got something coming up later here that it's a very similar question. So yes, let's move on to the next one. So it's a little related, but kind of different angle. So the question is, and comes from Rebecca. She says, I have 4 different investment accounts, my 401k at work, an IRA, a Roth IRA, and something that's just labeled as, she puts in quotes, individual account. Which one should I withdraw from first when I retire next year and I need income? I mean, this is right up our alley. It's a super great question. And I'm glad she's thinking about it this way, actually. Usually the question we get from clients that are just about to retire is they don't quite understand the whole paycheck recreation process in the first place. It's like, where is my money coming from? And this kind of gets to the point of what she's asking, but she's going a little deeper. She's saying, like, which one do I use first? And there is a choice. This makes all the sense in the world. So this is how we would address this. First of all, we need a plan set up to know how much spending is needed. I mean, it sounds kind of obvious, but before we'd be able to pick which account, we need to know how much we need to be drawing out. So it goes back to the financial plan side. Once we have that plan created and we can line up all of the income sources that she has, all the investment accounts, put it all in a timeline, well, now we can understand what the tax implications are going to be. Because if Rebecca here she doesn't mention this, but if she had a pension, and she also didn't mention her age. So if she had Social Security coming up, let's just make it up for her in 5 years. That would be a whole different choice in which account to draw from than if she already had started Social Security or started Social Security next year.
Future tax considerations come into play. If the client has significant amount of money in an IRA only, with just little bits in the other accounts, then when they get to RMD age, that could force them into higher brackets if we have time to work some out. So that may mean we want to draw some extra from the IRAs today.
Right.
To pull out and minimize that future forced impact. And so just a lot of different questions we need to ask and line up to actually be able to answer that question.
That's right. And one other one I thought of is inheritance. What are that doesn't come up in this question, but if there's a goal to leave some amount of inheritance, that will dictate which accounts we pull from, because some are better for inheritance than others. But anyway, I do want to leave some more practical advice in general. Okay, this is our broad stroke, kind of rule of thumb without having a plan. In general, you probably do want to fill up your tax bracket with taxable money first. So you'd have to look at your situation, see how much total income you need. And if you could meet that income need entirely out of your IRA only, and stay in a lower tax bracket, let's just say maybe the 12% or maybe even up to the 22%, maybe you draw that first set of dollars out of the IRA, preferably if you could fill up that first bucket of 15%. And then above that, you might choose to take from what she calls her individual account. And in that way, without us looking at the whole picture, at least you're pulling money out of the IRA account at a relatively favorable rate, and then relatively low tax implication on the individual account money after that. Again, very difficult to answer though without seeing everything in place.
And a known tax rate today that comes into play, right?
That's absolutely right. Yep. So this one came in from a client who is participating in an ESPP plan. We've talked about these in the past. So employer stock purchase plans. The question was, hey, I just got a large portion of my ESPP contributions sent back to me. Why is that? Now, this is actually kind of a common question, and it's we've talked about in past shows how ESPPs work, and they are challenging to some degree. They seem really straightforward, but this part of it can be challenging to some degree. So again, just to frame it up in case people don't understand what we're talking about here, for your employer stock purchase plan, you typically set a percentage of your payroll to send off to buy company stock at intervals. Maybe it's a quarterly or 6-month purchase interval. And what happens is the money gets set aside until the purchase date. So it might get set aside for a full 6 months, and then purchase date happens, and then everything gets applied to buy company stock. Well, the challenge is that there are both dollar limits that really translate into share limits, and then the plan has its own set of limits. And there's also the company stock moves around all throughout the quarter. So in this particular case, when I looked at this client's portfolio, their company had a stock price that was very volatile throughout the period. In fact, it had mostly gone down. Okay. So first of all, just backing up, because I kind of rushed through that. The company, in some cases, sets specific limits, and they might only allow, let's just make this up, 500 shares to be purchased in a period. So we have to keep that in mind. The overall plan may say we're only going to allow this many shares purchased across the company base, because they want to limit how much is occurring there, how much dilution is occurring there. And then there may be a dollar limit per plan period. So to just give a quick example, the company plan may have a dollar amount maximum that can be purchased per period, but that isn't the full dollar amount, as I'm sure you've seen this before, Matt. What happens is, let's say it's $7,500 can be purchased for that 6-month period. Well, at the beginning of the period, it takes $7,500 divided by the current stock price, and it gives you a number of shares. Let's just say that it's $75 a share, so it gives you 100 shares that could be purchased, right? Okay, but at the end of the period, the price has gone down. It's got cut in half. Well, if you tried to take your whole $7,500 and apply it and buy all shares, you would get way more shares than you were allowed to purchase. So it all comes back to figuring out how many shares can be purchased for the period. And then depending on what happens to the price through the period, that may affect how much of your payroll contribution can actually be used. Is that clear as mud? I'm explaining it to you, and I bet you don't even know what I'm talking about.
I certainly understand, but I think it would be confusing to get a check in the mail.
It is absolutely confusing. Now, some plans, they'll let you reapply that, but it is confusing to just have that returned to you. And then the question is, what do I do with it now? So if you have questions about it, just give us a call. I'll go through it with you with your specific company's documents so we can understand what happened. And then try to set a percentage that makes sense for you in the coming purchase period.
With those plans you work with, have you seen most companies have significantly lower limits than the IRS limits?
It can happen. Medtronic has a plan limit where I believe theirs is set to be 10% of your pay. And so you have to have a pretty substantial salary to even hit the limit on that. And in other cases, the company may be smaller, have smaller stock price in general. Maybe they're not as much of a legacy company. And so then they might set just a limit up front of the number of shares to be purchased.
Sure. And
neither of those really match necessarily to the $25,000 IRS limit. It's all over the board. Everybody has 401k on their mind, and they think, oh, I can put $23,500 into my 401k. It's just pretty simple.
And with smaller companies, most are private, get an annual valuation versus publicly traded.
You know, you're really not going to see the ESPPs in the private company space. And in particular, this question came from, public companies. So yeah, the private company, that's a whole different ballgame because they're only getting valued, on much bigger intervals.
Right.
And you almost never see an SPP in a private plan or private company.
I had one at my first job.
Did you really?
Long time ago. Yeah.
That's unique.
It was confusing.
Absolutely. All right. Well, so here's another question. This one's more for you, Matt. We sort of addressed this on a prior episode about just the changes that may or may not be material with the coming election. And so this question was, now that the new president is officially in office, because as we're recording this, really just inauguration day was a few days ago. So now that the new president is officially in office, do I need to be concerned about what my retirement plan and investment portfolio is going to do?
Yeah, great question. Obviously on top of everybody's mind. Last time we talked about this, it was prior to the election, and our general thesis was history and economics. History pointed to markets higher from election day to the end of the year, and economics really drive that regardless. And that certainly has played out. Markets, as history has shown, run up post-election, and they did that. We had a little bit of softness here in January. That's completely normal as well. But what are we expecting moving forward? Same thing. Economics play out in the long term. We're investors, so we look at the economic data, and that drives stock price long term and bond yields long term. Currently, the economy is fairly strong. There are some points of concern that have been there. Unemployment, as an example, has been there for better part of 19 months. That hasn't changed, but company earnings are strong and so forth. So that's not going to change. Some factors that could change company earnings would be any corporate tax rate changes, which leads me to one of the big planning changes that we have with the new administration. Is prior to this election, we had a longstanding assumption that the current Tax Cut and Job Act would sunset. And just a quick refresher on the sunset, that meant your tax brackets went to the prior tax rate, which was roughly 3% for most brackets. And then the standard deduction would be reduced about half, which simply put more money in the taxable range. So the average household, it was estimated, would be about $4,200 increase in taxes if it's sunset. It looks very, very likely now, with Republicans gaining the House, Senate, and obviously the White House, that it'll at least be extended for a period of time. Again, history shows that it's usually voted in permanent law change. Still don't think that that's necessarily going to happen. And then the second part that is a little more newer is that there is legislation in place to eliminate federal tax on Social Security.
Yeah, that could be huge.
That would be huge too, because right now the Social Security taxation rates were set in 1980, and they haven't changed. So pretty much anybody, unless you're a single person on Social Security and have no other income, but most couples, they're having to pay taxes on their Social Security if they're both taking benefit. So that would be a nice move. But as far as markets are concerned, I would just say we're probably expect more volatility. That's what Trump 1.0 brought us, or as I like to call him, the tweeter in chief.
Yeah,
right. A tweet or whatever we call them today can cause the markets to adjust pretty quickly. But again, economics drive long term. So unless the volatility is something we're concerned about, it doesn't really shape any changes for us quite yet.
Right. Yeah, we love to say in the industry, it'll just be more volatile year, which it sounds so just platitudey, or not even, that's not the right word, but it almost means nonsense. But when we talk about that, look at last year, was there volatility? Yeah, but it was mostly to the upside.
Yeah, we had a 10% drawback in July. We had a 7% drawback in the spring. That is completely normal in a bull year.
Right.
And we would expect that moving forward, but maybe in that 10 to 20% range is a possibility, but still in a bullish environment.
Sure. So what you mean by, expects volatility, just that there potentially could be some wider ranges of
I think
peaks
so.
and valleys. Yeah.
We've been fairly quiet, tighter range since we pulled out of the 2022 drawback from inflation, and so I think it's perfectly normal for the bulls and the bears to be fighting a little more in 2025, right?
Right.
To see who can take over and what economics are going to play out. And just some facts, right? Like President Trump 2.0, he's going to focus on tariffs again. So international investing is probably going to be pretty wild during his tenure. So may not want to be overweight international investing if volatility is a concern, right?
Yeah.
Just an example.
Well, before we get to this last question, I just wanted to just kind of check in quick. I know we've been both very busy through the end of the year, and I know we both have a couple of quick vacations coming up, but I would say well deserved, and looking forward to it. So where are you headed here in the next week or two?
Yeah, a week from tomorrow. So my daughter's graduating high school this year, and since we took my oldest son on a senior trip, we're taking my daughter on a senior trip as well. She chose Hawaii. So, and then we figured the first couple weeks of January is probably the safest for our firm.
Yeah.
The quietest for our firm. So we're going to take off now instead of some time after graduation and have a little bit of fun out there. So.
Excellent. I can't wait to hear about it. I was to Hawaii once several years back, and we've got to get back. It was great. It's kind of life.
Yeah, I'm looking forward to it.
That's very good. I am actually getting out of the office here in a few days to go see my nieces and nephews, do a little ski trip. Can't wait. Oh yeah, it'll be fun. They're finally to the point where they can kind of go down the hill without my brother sort of holding them with. He kind of puts like a dog harness on the smallest one, right, to kind of make sure that she doesn't get away from him. So yeah, it should be a lot of fun.
When's the last time you downhill skied?
Well, it's been too long. We used to go multiple times a year. I'm actually a snowboarder, and so he told me you better start practicing your shin exercises because you get really tight in the shins from the snowboards. Yeah, exactly.
Well, that'll be fun.
Well, it will be fun. Yeah, as we wrap up here, so I did have one other very interesting question that came in, and I think it's timely because it involves one of the companies local here that we work with, Inspire Medical, and the question said, so my company, Inspire Medical Systems, is switching HSA companies or HSA providers, and I'm wondering if you could help me, with how to get started, both in the plan and with my investments. So this is, again, timely because it's kind of, we're past open enrollment season, but a lot of times you can start the HSA, mid-year. And if you remember, we've talked about in the past, we advocate for paying all your health care costs, your deductibles out of pocket, so you can let your HSA balance build up. So this is actually very important when it comes to the plan you're using and how you're investing it. And so Inspire, it turns out, is starting to use a company called Health Equity, and we've got a lot of experience with them. It's a great provider. We don't manage anything at Health Equity per se, but we just are very familiar with the plan setup. They've got a lot of good low cost fund options or investment options from places people recognize, like let's say Vanguard, that's a big household name. And so it's a good thing. So what I responded to this client, and what I would tell everybody, anybody had a question, you first just want to get enough built up in the HSA to meet the minimum. So there's usually a minimum before you can then start investing. It's usually about $1,000. And with Health Equity, they have a feature in there called, I believe they call it a cash replenish option. And so you can actually go into your portal and set it up so that it will automatically fill up to $1,000 in the cash portion. Once that's hit, then it'll spill over to your investment side. And that way, if you do use some money out of the plan to pay for some healthcare costs, it'll build up again. The other thing to keep in mind with health equity and with all the HSA providers is there's usually a monthly service fee, and so it's not very big, but it does eat away a little bit at that cash balance. So you always have to replenish it a little bit. Anyway, so set the cash replenish option up at least $1,000, but at most maybe your deductible level. Again, though, if you're using the strategy of just trying to pay for things out of pocket, just set it at the minimum. Beyond that, you can set the investments at first, maybe to one of the target date funds. They make kind of the easy button where you can just pick a target date fund, something in the sort of moderate to growth range. Let the account build up. If you want to make it really simple, you could just pick 2 funds. A portion of large stocks and a portion of bonds. Keep it cheap. And once you've built up a few $1,000s in there, maybe we should target something around the 5,000 range or more. You could actually use Health Equity has a Schwab brokerage option as one of the investment options. So you could then, once there's enough money to matter, push the balance out to a full Schwab brokerage account and then have the whole lineup of investments available to us. You can do it yourself. It's good to have choice, but it's also, it can be a challenge to have too many choices as well. So once you set up that brokerage account, if you're working with an advisor could certainly line up a portfolio with that. We do that for several clients. So hopefully that was clear. Definitely good to set the plan up, target at least $1,000, maybe your deductible, make the account investments very simple. And then eventually I think maybe consider the Schwab brokerage option, just because it opens up so many other options for you. That was it. We've got many of these questions that come in, but we only have so much time on the show. So anything you want to add before we break, Matt?
Yeah. What's your number one New Year's resolution?
Oh man, I thought I was going to get out of the show without listing that. You know what it is? It's going to be to take more actual out of office days.
I think that's great.
Not the out of office days where you are not in the office and you work from home, but an out of office day where I actually don't check my phone. So that would be helpful mentally, probably for both of us.
We are super guilty of that.
Well, we love what we do, like when clients need us, we just feel like we got to be there. And so, but everybody needs a break, and we need to model the financial freedom that we are espousing for clients just as well for us too. And so part of this is a personal challenge and a personal, I guess goal to model that for people.
Well, don't bring your laptop on your ski trip then.
That's good. That's a good point. I will not. Well, very good. Well, thanks for being with us today. If you have questions or just want to know more about the team, you can visit our website, perspective6group.com. So if you're a fan of the show, please leave us a review. Send us questions that you want us to answer on the show. But until next time, remember, financial freedom takes more than money. So find your purpose and make a plan to live your life well. If you need any help, we're here for you. Take care of each other out there.